All right, welcome everyone to this new live session with a user. So as you know, these are basically a sit down where we sit with some of our members to walk through how they use the platform, for what strategy, what do they like about the different data, and how do they use things. Today we have Bekim with us. So welcome, Bekim, happy to have you.
Hello, good to be here.
Great. So let's start it out simple. Can you just tell us in a few words a bit of your background? So what do you do outside of trading? How long have you been doing this? Just so that people understand a bit of your profile before diving into the technicals.
Okay, so I'm a restaurant owner.
Nice.
I've been in business all my life, and then in like around 2010, I got interested in trading. And then around 2015, I closed my restaurant for lunchtime and only open for dinner. So then I had my whole day free.
Nice.
So around 2014, 2015, I began to start trading full time during the day.
Very cool. Right, and makes a good mix now. Trading during the day, restauranting at night.
Yeah, well, luckily I have my wife, and she works at the restaurant, so she can help me, so I can focus on my trading during the day, and she can take care of that. So I'm very grateful for that.
And so you told me, and you were also very active in our Discord, specifically for the IV rush strategy. So this basically playing earnings before the release, really not going through the release, not going through IV crush, etc. You're playing the inflation basically of IV and really holding positions before the release. So let's actually start on that. Can you tell us how you used to do IV rush basically? So what type of data you rely on, what type of positions, how do you play it, and then we'll transition to how you do things with EarningsWatcher now basically.
Okay, so typically for IV rush, I backtest trades anywhere from 14 days to 1 day before, and to see if it's profitable, it's usually through IV build and a combination of movement also. I mean, you want movement also. I mean, sometimes you make just on the IV build. I think it's more, with your side of things, where it's the day before where you can make money for just the build alone. But generally, you want the movement and the build also, and it puts a floor on your losses for the trade.
Sure.
Very limited losses. I mean, if you do it right, I mean, sometimes you can get unlucky, but generally, the biggest loss is never much more than like 10%. Unless something is totally wrong in my analysis.
Yeah.
And usually a lot smaller than that, like 35.
That's one of the advantages of IV rush is the somewhat little exposure, because you're basically just holding for theta decay. That's your only challenge. And especially as you mentioned, any stock move can help you because IV is building up. So basically the break even of each of the positions are still very low. They're not as high as going through the release. So two aspects, and this is a good thing about IV rush, is that the IV can drive the trade, but also the stock move. And so this is the data used to look at to backtest basically how entering a straddle. What was the usual timeline to enter and exit that you usually look at?
It can most of the time it's anywhere from 4 days or 7 days to 1 day before.
Okay.
Most of the time.
And then you exit usually just before close. How do you handle the exit?
I usually just if I have a profit, I'll usually close a little, and I can close a little, and sometimes if it really starts going in my favor, I'll set profits, and sometimes I'll adjust by rolling the puts or calls down or up once it's made a good move, so that I give too much profits back if it reverses.
Okay, yeah, makes sense, because you want to avoid basically the yo-yo situation where it rises up and then it goes down to where it was. So this was the stock move driving the profitability of the position. If it reverses, you lose at that. So you're basically adjusting.
Form of gamma scalping, kind of, you could say.
Yeah, exactly, kind of a gamma scalping approach. And then so let's transition to and actually let's use a real life example. We'll look at it in a second. Once you discovered EarningsWatcher, how did you add basically what we do in IV Rush to what you already do, basically your existing workflow. How did EarningsWatch fit basically in?
It fit because I can look at some of my names that I'm looking to trade before, a few days before, and a lot of them will be on EarningsWatcher, and I can see what that's predicting a few days before also, if it's green or red.
Nice.
And if it's red, I can stay out of the trade.
Exactly. So it's another layer basically on top. So let me here maybe share my screen so we can show the audience what you mean by this. Basically, you would look at, so this is our IV Rush screen. The approach here, so for our audience, and so they understand how this fits into your workflow, you mentioned how there are really two factors you're interested in when playing IV Rush. There's the inflation of IV, and then there's the stock move. Basically, you used to backtest data to see, okay, if I enter at this point and I exit at this point, how do usually things go, basically? And so whatever is most profitable, you enter that. Basically, what this tool does is that it really focuses on the IV component of it. So this is the black line you see, where we basically model the past IV. So you can think of all the past earnings that you saw that you backtested. Now, we're also scanning them, but to sort of make this model of IV that's really focused on isolating the driver of the IV Rush, the at the money IV Rush, and actually the earnings component of it, if you think about it. And so this helps you to tell you, okay, even if the backtest can perhaps show good results, maybe those good results are coming just from the stock moves. So that's less predictable, and that's not really help you to really pinpoint each trade. Now, on top, you can say, okay, given the historic modeling of IV, so here Airbnb is showing that, as you can see, the black curve is showing an expansion there. So there's potentially actually room for IV to rise, and so to make the straddle profitable. Let's just look at another name where it's not necessarily the case. So Coinbase, that's also releasing tomorrow. So I think this is a good case for you, Bekim, where you see the projection here is negative. So the modeled past IV is quite flat. So we're not really, there's not really any projection of this rush being actually efficient in making the straddle profitable. So these would be the kind of name that you would skip, basically, if I understood correctly.
Yeah,
right?
That's actually funny you say that, because that's one that I have backtested. And it is, I can't remember what it was, 2 days or 2 days before, and it was a profitable trade, but I looked at this information and I skipped it.
A lot of more sophisticated and say expert members who obviously would combine things. So perhaps people have seen, and you yourself, Bekim, have seen Dan, who composes, uses some of our data combined with some of MentorQ data for GEX levels, etc. This is what I like about you, is really, again, another use case of combining basically this intelligence for the IV Rush to what you usually do, just adding a layer of intelligence to say, oh, let's actually skip this or skip that. By the way, do you, Bekim, usually play straddles or strangles? In what type of positions do you play? So when you hold?
I usually try to keep it delta neutral, but it depends what the strikes are. If there's a strike that's right at the price, then I'll usually go with like a 50 delta straddle, or sometimes I'll go slightly out of the money strangle.
How do you usually decide between if it's a wider strangle or a closer straddle? Do you have any criteria in that of how to assign for each?
No, I look at the where it's trading at, and like where if the price is between the strikes, then I usually go with a strangle.
You try to find the basically closest and delta neutral, either straddle or strangle for each.
Yeah.
That's quite interesting, because I think so. Obviously, strangles are more exposed, so they will have more theta decay eating at them, but then they can make more profits.
They make more profits. This is a trade-off, I guess. I try to control my losses as much, so that's probably why I do that.
That's a smart approach, yeah. And so let's actually move to now an example you also started actually quite early. And so that was this time confirmed by EarningsWatcher. So perhaps before I'm sharing this, you have something you can share to show us the Airbnb trade that you took. And the reasoning behind it, basically. For our audience, basically, Airbnb is a good example. As you can see here, from our tool, really, there is a high projection based on what happened in the past. So this past modeling of IV, it's the black curve, basically, that you see there. You can think of it as the nominal behavior of IV leading up to the release. So this is really the main driver. This is what's driving the inflation in IV. Really, you can think of it as a canonical model, basically, a very generic model of what's behind those backtest results that Bekim or other people will look at. And you can really think of it as this is something that isolates the root cause. So if the rise in that historic model is high, it really means that there is a substance there. Basically, the results of the backtest really do come from the IV inflation. By the way, this backtest we're talking about can easily be done with some coding using our data, if people are interested in that. But the idea is that really, sure, backtesting is nice, but it's really just show you the symptoms. Now, what's behind it is the factor of this, earnings at the money IV. Okay, so we see now your screen share. Go ahead, Bekim, explain if you like what we're looking at here.
So I took the initial trade. You know how I look at beforehand. I look at to get an early. So I got an early here at it looks like I got it on the 10th. So that was 2 days ago.
Okay.
And you know that trade, it wasn't really doing that great. So I earlier on today I just closed it out and took a little profit here. You know. But
okay, so the stock moved at this point. So you took that profit.
I took it on the one in that one because of the theta decay. If the earnings is on Thursday, I usually go out to the following week. But so I did that, and then I got into that one, and I closed that one out today at some point. And then I also took the IV rush for tomorrow's expiration that has to be closed by today, and that was here. If the earnings is on like Thursday after close, then I'll maybe go out an extra week. But if it's not, if it's on like a Monday or Tuesday or Wednesday, then I'll just do like the same week.
Smart. This is very smart because especially for names like Airbnb, earnings are so Friday, the first trading day after this is Friday, and so as we usually say, theta decay effect on options on the weekly expiration that expires that Friday is quite high. So playing the closest expiration on that last day, you're putting yourself in a difficult position where the IV rush needs to be really, really high to counter the theta decay. It's actually smart to go a week out or a month out or further out, still get the benefit of IV rush, but with less theta decay. And so this is the advantage in, again, knowing the driver behind this place, so that historic model we're looking at. So if I understood correctly, let me bring back my screen here and we can start looking at things. You liked Airbnb because basically what you usually do is that you look at these curves, but early on. So you mentioned how you like that, the fact that we start tracking these things 5 days before. And so just the visual of the curve basically tells you, is there something there to ride, or is it very flat like we saw with coin, something, so nothing much to play there. Did I get this correctly?
Yeah. Okay. So I can use EarningsWatcher to even if it's a profitable backtest, I can use it to skip it in case this might be the time that it's not going to be profitable.
Exactly. And notice how we like to, as you mentioned, play the last afternoon to same point as you, where we really reduce our theta decay. We're really exposed to the last afternoon, and it can also be used to snipe things, as I like to say, where you look at especially the last hours of the black curve, basically 15, 30 minutes, 40 minutes from now, you see where there's really an uptake that starts in this IV regime, basically the main driver. And so you can know, oh, it's this is a good time to enter, really ride that rush. What I like about your approach, Bekim, is that you're basically spotting these, but even early on. So Airbnb that has, you know, a very consistent small rises, as you can see, starts from 5 days, 4 days, 3 days, 2 days before, and then really picks up. But so it makes a good candidate to play this on. And so now you have your last position. Let me bring it up. So now you currently have one that's the closest straddle that you're still holding, but with the closest expiration. Am I correct?
Yeah. So I had the one that I got into for 912 over here, and then I closed a little bit for 962, and then it made a pretty good move down. So I rolled my puts down, and that's why I'm. So now it's a strangle.
I got it. So it's an interesting approach how you, again, this is like really scalping approach. Whenever there's a profit, you take it and you readjust your strikes. I followed also in the paper trading some positions earlier. So notice how, so this is what's behind why sometimes the strangle is really in a tough position, because it has to battle theta decay, as we said, on the expiration day. Seems that things are going better for the, you know, just the straddle one. I think it's quite close to what you have. All right, I think this was a good session overall. We talked about a lot of interesting things. Any last words to wrap up, Bekim? Let's, you know, as the classic, any advice basically you would give to maybe our more beginner or people who are less familiar with these strategies, or maybe yourself 15, 20 years ago, what would you advise yourself?
Don't get too excited. Trade as small as possible when you start, because there's always going to be trades, but it's hard to say when you first start. Now you're excited, you want to make money, but it's like, you know, there's always going to be trades. So if you can start off as small as possible in trade, you know, real money, but as small as possible, and learn.
That's a great point.
Don't start adding more size until you're a consistently profitable trader.
All right. So thanks everyone for watching. Thank you, Bekim, for joining us. Let us know in the comments if you have any questions about this approach or any things you'd like to learn more. Happy to help. And we'll see you in the next session. Bye. Bye, Bekim.
Thank you.